Good afternoon, everyone. Welcome to the Ess Biztools and our affiliates webinar COVID-19 Survival Panel. This is session 11 of this presentation. Today we have two very interesting keynote speakers. We have Arthur Ackers from Equitize. How are you today, Arthur?
I'm very good, thank you, Peter. How are you?
Good, thank you. And Paul Barnaby, predictive accountant and the Australasian representative for Plan Guru. How are you, Paul?
I'm great, thanks, Peter.
That's very good. So we'll just move on. Our presenters, as I just said, are Arthur Ackers, who's the operations manager for Equitize, a crowdsourced funding intermediary organisation that operates in Sydney and also Auckland, New Zealand. And Paul Barnaby, a prescriptive accountant and Australasian representative for Plan Guru, an international software company that produces fantastic software for budgeting, cash flow forecast, and predicting balance sheets. And we'll be hearing from both of those gentlemen shortly. If you have any questions during the webinar, can you please go to chat and type in your question? Or if you're watching us on our live feed on Facebook, and good afternoon to those people on Facebook who are watching us, welcome. You will not be able to directly access the live webinar to type in your question, but please send us an email, peter@essbiztools.com.au, and we will reply to your email. I will forward it on to either Arthur or Paul to get their response, and we will send you the details later. And we will place the question and the answer on our website. I now want to introduce you to Arthur Ackers. Arthur is going to talk to you about a very interesting subject on crowdsourced funding, democratizing investing. So how are you, Arthur? And I'm going to switch it over to you now. Thank you.
Thank you very much, Peter. Hi, everyone. Thank you very much for joining us today. I'm going to share a presentation that I've put together today. Here you go. Okay.
Yes, it's there now, Arthur, so you're right.
Thank you, Peter. So as Peter just said, I'm head of operations for Equitize. Equitize is an online investment platform operating in Australia and New Zealand. And we help all sorts of businesses to raise capital to fund their growth and their success. We have been operational for the past 5 years, and we have different channels that I will show you today to raise capital. So really what we're trying to do is to democratize investing. So I'm going to tell you a bit more about the different channels we use and you can use for the companies you're working with to raise capital ahead of potentially difficult times over the next few months or years. Businesses still have to fund their growth, get out there, expand, whether it's in Australia, New Zealand, or internationally. And we still see a lot of very, very good and successful businesses looking at raising capital at the moment. So I think it's very important that we give as much information as possible to accountants who are direct connections to these businesses so that they have the tools to help these businesses make the best decision when they're looking at raising capital and growing the business. So today I'm going to focus a lot on equity crowdfunding, which is a new way of raising capital, which came in Australia around 2 years ago. It's been available a bit longer in New Zealand, in the UK, and in the US, but Australia has been a bit late on that one. But now it's fully operational and it's doing quite well so far. So equity crowdfunding is a new way of raising capital, which allows anyone to invest in early stage companies. So now you don't anymore need to be a high net worth, sophisticated investor in order to invest in a private company. If you are a retail investor and you want to invest a small amount, you can still do through equity crowdfunding platforms like us. So how it works is businesses can raise up to $5 million every year from retail investors through equity crowdfunding platforms like us. And then you can raise more if you tap into our wholesale network. Those retail investors, they can invest very small amounts. It can start from $50 and they can invest up to $10,000 if they are retail. And then if they show that they're wholesale sophisticated, they can invest more than $10,000 through a S708 certificate. So it's really a very simple way of getting access to anyone to those businesses. And it's a really good way of engaging your customers, your close network, your friends, your family, and also anyone in Australia who may like your business, want to back the business and become an investor and help the company succeed. So I just touched base a little bit on that, but the key benefits of equity crowdfunding for the companies are that it's both it's a marketing exercise, but it's also a capital raising exercise. So yes, the idea is to raise capital for the company to fund the growth of the business, but it's also a very good way of reaching out and getting more people, more brand awareness. So it's a good way of increasing market awareness, of growing your user and customer base, because those people who will invest, whether it's hundreds or thousands of small investors, they will most likely become customers of your business if you're like a B2C company. So shareholders become loyal brand advocates that are literally invested in your success. And it's also a proven model that can be repeated for subsequent capital raises. So once you've done an equity crowdfunding campaign, it's very easy, whether it's 6, 12 months, 24 months later, to launch a new offer, use all the documentation if you've been using on the first crowdfund, to re-engage all those people that you engaged in the first time, and to really get an even better result and raise more capital and get even more brand awareness out of it. For investors, really the key benefits are that now everyone can invest and participate in those early stage businesses. You don't need to be very sophisticated and to get a very, to invest like 10, 20, 50K, you can invest $500, $1,000 and still back those businesses and benefit from the success of those companies. So investing can start from just $50. Obviously there are risks in investing in early stage private companies. These are illiquid assets, but obviously the potential returns are also greater for those investors. And it's a very good way of diversifying a portfolio, because obviously private companies are not correlated at all to what is happening in the market. So we see a lot of sophisticated investors will tell you that they have usually like 80–90% of their portfolio, which is invested in traditional assets and kind of liquid assets. And then they will have 10–15% of their portfolio, which will be actually invested in those early stage private investments, which are more liquid, but offer potentially a greater return. So there are some businesses which are particularly a good fit for equity crowdfunding. So I'm going to touch base on a few of the things we assess on our end to when we select the companies to run an equity crowdfund on the campaign. So as I said earlier, the real success of a crowdfund is both capital raising and marketing. And it's really a great way of engaging your community and your customers in the business. So B2C businesses are a really, really good fit for equity crowdfunding because they have an active customer base that already love the company and they can really leverage these people. So an example would be a beer company. We've done a raise, I'll show you an example later, but for a Sydney-based beer company called Endeavour Brewing Co. And that's typically a very nice company to raise capital for when you're going out to retail investors, because pretty much anyone in Australia has always dreamed of either having their own brewery or, you know, being a shareholder of a brewery. And that's a way of getting into that. So B2C companies do very well in equity crowdfunding. It doesn't mean that B2B businesses cannot do equity crowdfunding, but it means we will need to put a little bit more effort in marketing the offer and getting like more people aware of the business, because initially, like everyday people won't know about a B2B business because they will never be, you know, direct customers of this business. It's important that the company has like a distribution network, so like engaged customers and partners that they can leverage for the raise. Strong commercial prospects, because again, this is an investment that we're going to promote to investors. So we want to have some key traction figures, key achievements that we want to be able to advertise to these investors to show that it's a great investment opportunity and that they may very well make a great return on this investment. And then obviously a reputable team. It's very important again to show to investors that the team has experience and that they are the best team there to carry on what the business is about. So that's some of the key things we assess when companies come to us to raise capital. There are a lot more things we look at, but just to give you really a quick snapshot of typically what could be a successful company for an equity crowdfund. So yeah, having a B2C, being a B2C business, having engaged customers, having a strong brand, all of this can be very helpful. So looking at the past 2 years in Australia, but also if you look at foreign markets, which are a lot more mature with equity crowdfunding, like the UK or New Zealand, the most successful industries for equity crowdfunding are fintech companies, food and beverage companies, retail and online companies, and shared economy companies. And there is definitely a common denominator in those four kind of businesses and industries. They're all very often B2C businesses. They all have engaged customers. They all have strong commercial prospects. So fintech is one of the biggest industry in the early stage businesses in Australia. It's been very successful to date. There are a lot of examples of successful companies exporting from Australia. So we see a lot of interest from retail investors for those fintech companies. Food and beverage is also a really good business, a really good industry for equity crowdfunding. I talked about the beer company, can be a snack company, can be a restaurant chain, like can be many various businesses, but food and beverage tend to do very well. Retail and online also are very topical. They usually have a massive customer base through their newsletter and their sales channel, so they can really tap into those people to get them to invest. And shared economy is very similar. They have, you know, they're like a marketplace. They have two sides, which are the customers and the providers, and they can really leverage both those sides to really run a successful raise. So example of shared economy companies we've worked with are, for example, Car Next Door or Mad Paws, which is a company to look after your pets, have been very successful through this kind of raise. So again, this is an overview. If you work for a business which doesn't necessarily fall under those exact criteria, it doesn't mean you cannot consider an equity crowdfund. We work with a broad range of businesses. We want to offer different investment opportunities to investors, and we see a lot of appetite from these investors from various stage and industries. But that's just to give you a brief idea of what can be like a sexy business for equity crowdfunding. And now just to give you maybe a few tools on how you can help those businesses you work with to be CSF ready and to be ready to reach out to platforms like Equitize to have the highest chance of success of engaging with those companies to proceed with a capital raise. So first of all, a very simple requirement in Australia, in order to do an equity crowdfunding campaign, you need to have a minimum of 2 directors. So very simple. If the company you're working with only has 1 director, you can already, and you're really considering equity crowdfunding, you can already start working with them on a second director that they would like to nominate. They could join the business because it's a requirement. You cannot proceed with a CSF raise without those 2 directors. It is also very important that you have up-to-date pitch deck and financials in place, because the first thing you're going to do is you're going to contact us and tell us, I work with this company, they're looking at raising capital, but we need to have a good understanding of what the company does, what is the value added of the business. You have to convince us first that we can manage a successful raise for you. So having an up-to-date pitch deck and financials is very important. Whether you go to us or to other investors, it's key to be able to transcribe your message and the success of the companies to those investors. Another important point is having a strong constitution and shareholders agreement, because when you do an equity crowdfund or when you welcome new external shareholders, you really need to have a strong contract in place for the future of the company. So it is very important that the constitution and the shareholders agreement has been reviewed and considered for the kind of raise you're looking to do. Typically, if you do an equity crowdfund and you succeed, you're going to welcome 200 to 1,000 new shareholders. Could be more, could be a bit less, but you're going to get a few hundred new shareholders in the company. So you need to make sure that the constitution and the shareholders agreement are set to manage those thresholds, because, for example, you don't want to have 100% approval for any resolution, because it's going to be very complicated for the company to go out to 500 people and to get their approval on any resolution. So you want to make sure that the thresholds are there. Another example that is important for businesses that are raising capital is make sure that you have drag and tag along rights, which means at some point, if you want to sell your shares, then all minority shareholders have to sell their shares with you, or in the other way around. But it's important to protect the founders and the minority shareholders of the business as you're about to welcome small shareholders through a crowdfund. Another very important component is the financial/forecast model. That's also a very important thing we assess when businesses come to us. So that's really something you can help those businesses with, is building a strong forecast model in order to be able to pitch to potential investors as to where the business is going towards, what are you going to do with the funds, why are you raising capital, why should people invest in this business, what are the potential returns, what do we think the revenue for the business could be in 2, 3, 5 years. And that's really important to help them build, because not all companies have the sophistication to build those complex model, and then to explain to investors how they got there. Then the last 2 points are not as important, but I still wanted to talk about them today. The 5th point is I'm talking about having an engaged community. So as I said just before, equity crowdfunding is very much also about engaging the network around the business. So it can be existing customers, it can be your friend, your family, your community. So if a company has an existing engaged community, it can be very, very helpful to guarantee a very successful equity crowdfunding campaign. So the broader and the more engaged the community you have, the more likely you have to run a very successful equity crowdfunding campaign. And then pre-funding, I think that's an issue you're going to probably see with a lot of investors. Well, anyone likes to see pre-funding in an investment opportunity because it shows that other people have done their work and are interested and think that it's a great investment opportunity. Rarely people want to be the first ones to invest. Very often they'll be like, okay, I'm willing to invest, but you need to have a cornerstone investor on this round. I want you to have secured $50,000, $100,000 before you can commit more. So if you can help those businesses before they get ready to do a crowdfund, to work out who in their network, being sophisticated investors, angel investors, potentially family members who have who may be a high net worth investors, how much and how likely they can get some money in from those investors. Can there be a cornerstone investor? It can be 10, 20% of the full amount that the company wants to raise, but still, it really helps when you go out then to external investors to have a bit of pre-funding to show that, yes, it's already backed, there is already this much invested, and now it's just on top of it. So now, just to give you a bit more background on Equitize and what we do. So we're the leading investment platform in Australia and New Zealand for online investments in private companies. We've been operating for 5 years now in Australia and New Zealand. We have raised successfully capital for 74 companies to date, and we've raised more than $44 million overall. That was across more than 10,000 investments. Our success rate is 90%, so it means that 90% of the offers that went live on our platform over the last 2 years have been successful in raising capital. We have a database of around 45,000 people we go out to for every investment opportunity. Usually, like on average, 90% of these 45,000 subscribers are retail investors, like everyday people, and 10% of them are actually high net worth S708 investors. So I discussed mostly about equity crowdfunding earlier, but I just wanted to give you a quick overview. If you were looking at raising capital and you wanted to have a chat with us, there are other channels we tap into to raise capital. So one of them is equity crowdfunding, where anyone can invest, but we also manage some wholesale only offers where only sophisticated investors can invest. That's traditional S708 investors, larger tickets, usually 10, 20 to 50, 100K, and we promote an offer to our network of sophisticated investors, and we get 5, 15, 10, 15 investors investing larger tickets in the round. We have a network of institutional partners who sometimes engage in those raises. And then we help companies with spread when they're looking at IPO. So spread, I'm sure you know about it, but it's just in Australia, in order to list on the ASX, you need to have at least 300 shareholders on your cap table. Often businesses don't have 300 shareholders yet when they run the IPO. So we just share the IPO to our retail database to ensure that we get those 300 names and that the IPO is going to be successful for the business. These are just a few examples of the kind of industries and businesses we've been working with. As I said, a lot of different industries and stages. Zinja is a fintech company. Manrags is a socks and jocks subscription company. Endeavour Brewing Co. is the beer one. So here you will see like really a broad spectrum of businesses, and that's really what we're looking for. We need to help various businesses raising capital. I think I'm running a little bit over time, so very quickly. We've talked today about the different offers. I just wanted to show you a very quick case studies on these different offers so we can have like actual examples. An example of a very successful equity crowdfunding campaign we've done in Australia is for Zinja. Zinja is a neobank, so a fintech company. They have been extremely successful to date. They've just secured 6 months ago $450 million investment from an investment bank in the UAE. So they've raised 5.5 million over 2 rounds on the platform from 2,500 investors. So shows you really the number of investors you may be able to welcome, but it's been very successful for the business, and all those investors were the first customers and the first able to get the debit card when they launched the debit card, for example. They also work very closely with those shareholders to get feedback and insight from those shareholders as to what features they should launch, what they would like, what they would not like. So it really helped the brand get even stronger. Another quick example is Endeavour Brewing Co., the beer company based in Sydney. We've raised for them 560K from close to 600 investors. It was the first raise for a beer company in Australia, very successful. They were super happy with the results. So that's the kind of raise you can do with your businesses in Australia. Quick overview of wholesale offers. So we've done a raise for Car Next Door and for another company called Daisy. These raises were only available to high net worth investors on the Equitize platform. So we have a network of 1,500 investors, high net worth. We raise typically anything from 250K to $1.5 million. We've raised 1 million for Car Next Door, 1.5 million for Daisy. It's high net worth is usually quite a quick and easy way of raising capital if you're not necessarily looking at this brand awareness and marketing and PR, and you just want to do like a quick and easy round and you have like a strong business in place, then it can be a very powerful way of raising capital. And then just a quick example. So Identity is a company we've helped with their IPO. We've raised $1.7 million for them from 289 investors. So really the goal was to get as close as possible to the 300 names to make sure they could list on the ASX, and we were successful with that. So that was a very great outcome for them. So that's pretty much what I wanted to cover today. Here are my contact details. If you have any question or if you want to have a discussion with us about a business you're working with, feel free to contact me. We always like to talk to businesses and see how we can help them. So yes, I hope this was clear, and feel free to reach out anytime. Thank you very much.
Thank you very much, Arthur. I meant to ask you before about early stage innovation company. I had a inquiry a couple of days ago. Would you care to comment on how you can assist a company that might aspire to the recognition of being an early stage innovation company?
So we do often have businesses who are raising capital who are ESG compliant. It's a plus for the investor. So we do promote it to potential investors. But as an intermediary, we don't assess the ESG status of those businesses. It's more the company will come to us and say, we are ESG compliant. That's more a plus for the investors. But yes, you don't need to be ESG compliant to run a successful raise on our platform. I would say less than 50% of the businesses we work with are ESG compliant. So more than 50% of them are not, or have not disclosed it or promoted it to investors. So it's not a requirement. It's definitely a plus, but it's not a requirement.
And is there investors in the marketplace looking for ESG compliant companies, or is that just accidental?
To be honest, I don't know the exact answer, so I don't want to say something wrong. I would assume so, because we sometimes, yes, get inquiries asking if it's an ESG investment, but honestly, it's not the main question we get from investors.
Okay.
Investors are more into the financials, what they think the business is going to achieve, what they have done to date. More than that, well, at least on our platform.
Righto. Well, thank you very much, Arthur. If we get any questions, we'll come back to you later on, of course. And if, as I said earlier, if people who are watching this at a time to suit yourself want to talk to us or talk to Arthur later on, please send me an email and we'll forward it through to Arthur. So thank you. And we're just now going to go back to our next presentation. I now have pleasure in introducing you to Paul Barnaby, who's a prescriptive accounting consultant, and Paul, I'm sure, will explain what that terminology means, and the Australasian representative for Plan Guru. So good afternoon, Paul. How are you? I'm
good, Peter. Thank you very much. And I'm not sure where the prescriptive accounting term came from. It didn't come off my material, but
I thought you said it one day. We've probably given it to you.
I prescribe to businesses like a doctor. I give them the solution to their problems. Not just with drugs, Peter. I hasten to add. Let me share my screen, and we'll get started on my topic, which is a very handy addition to what we've just been hearing.
Very much so. Yeah, your slides are up now, thanks.
Here we go. Here we go. So the topic of my presentation today is preparing proper three-way budgets in under 60 minutes. And what I've got today is a COVID-19 case study, because what has reminded me in these last few months is never has there been a more important time to focus on our futures with the advent of this COVID-19. And of course, it's not all been bad news. Ask Zoom if they've got a downturn. But it gets more interesting. I did hear recently of a regional news agent in Queensland who has been enjoying record sales. In fact, their March and April sales, both months, were ahead of December last year. Why? Pubs and clubs and TABs were shut down. So where did the gamblers go? They went to the news agent. Books, magazines, you name it. People bored, go to the news agent. What have they got? They've been enjoying record sales. So it's not always bad news. It can be good news. But I guess it's of interest that I have got a case study, and even more particularly of interest to me personally, because I've worked quite a lot in food and beverage, which Arthur was referring to as well. It is in fact a restaurant in Brisbane. But where I wanted to start was just a little bit about me. And yes, I'm a chartered accountant. I was, for a good number of years, managing partner of a second-tier firm. And it was during that time that I had what I think is called a light bulb moment. And one day I just decided it was time I started working with people's future, not their past. It was time I stopped recording history and started to create history, or help my clients create history. And that's what I now do. I consult and implement in what I call predictive accounting. And predictive accounting is doing for future time periods what we're used to doing in the past with historic accounting. Now that of course includes budgeting and forecasting, but it can include financial analysis and strategic planning, all a part of which Arthur was alluding to before. I have my own consulting practice styled beyond accounting technologies, but as Peter said, I'm also the regional integration consultant, Asia Pacific, including Australia and New Zealand, for Plan Guru, which is a company based in the US, and they produce a specific tool and tools for the budgeting process. So I've worked with, over recent years, many hundreds of accountants, CFOs, people in business, and I like to think that my job is to help accountants and CFOs look like superstars. Because we do have a need for strategic plans and budgets, and often those needs are driven by external factors. It might be the bank asking for a cash flow forecast to support a loan application. It might be the whole crowdsourced funding that Arthur's talking about. You've got to have proper strategic plans and budgets for that. It might be one of the 50-50 subsidised, well not subsidised, but government-backed loans. In each case, you're going to need strategic plans and budgets. But a lot of advisors, I think, miss the point that every business needs a strategic plan and budget every day for their internal needs, not their external needs, their internal needs. Because there's an old hackneyed saying now, if you fail to plan, you plan to fail. But I bring it up because it is so true today. And if you look at COVID-19 and you look at the impact of that on a business, and you know what it is, you can plan to avoid or at least manage that impact. And as I alluded to before, the federal and state government assistance packages may in fact force you into quantifying that impact so that you can make application. And again, if those government supported loans, you will have to supply a business plan, including a budget. And that won't be just a revenue statement. It'll be full predictive financial statements, including cash flow that will have to be prepared. So you need a budget. What do? You reach for Excel, right? Wrong. Excel is a great tool, but it was never built for budgeting. It was built for a variety of needs and uses. It was built for engineers. It was built for chemists. Yes, it was built for accountants, but never specifically for budgeting. And the major reason that I am so anti-Excel for budgeting is, if you want to get on the internet and research a fellow called Ray Panko, he's a professor at the University of Hawaii. And he's what I call a spreadsheet nerd. He spends every day looking at other people's spreadsheets. And he's researched internationally released spreadsheets, and he's found that 91% of them have got errors in them. That mightn't be surprising, but what is surprising is that 91% had errors that the authors were not aware of, and maybe are still not aware of, and that's scary. But the other issue is that Excel budgets take 10 times as long to prepare, so why would you bother? There are other apps out there. I often say, if I as an accountant recommended to a business that they record their financial history and prepare financial statements using Excel, they'd think I was mad, because there's MyOb and there's QuickBooks and all the other ones. And it's the same with predictive accounting. Why would you use Excel when there's apps out there to do so? So what are we going to do? Well, let's just have a think about, first up, what should be contained in a successful budget. Firstly, as I said before, it's got to be profit and loss, balance sheet and cash flow. No point in just revenue and expense. It is not the whole answer. Unless it's a startup that you're looking at, you've got to use a starting position, in other words, the most recent historic results. And here's the biggie. It's got to be driver-based. When I first learned budgeting, I was told, take last year's results, add a few dollars or take a few dollars off for next year, and that's the budget. No. A good guess might be better than that. What you've got to do is look at what drives it. Is it the number of transactions? In our restaurant case, we're going to be looking at number of customers. We're going to be looking at average cost per customer. We're going to be looking at the wage cost, because the food cost and wage cost are the two big drivers in a restaurant. But you've got to look at other drivers. What's the investment in R&D, plant and equipment, motor vehicles? What's the staff situation? Those are all drivers. And you've got to take those into account almost on a line-by-line basis. And this is where it can get time-consuming, and again, why you need a tool. When it comes to the type of data that you're looking at, you've got to have four. In fact, there's three shown there. Historic, of course, is the fourth. You've got to have a budget. You've then got to be able to bring in the actual easily from Xero, QuickBooks, or Mob, or whatever it happens to be, so that you can compare that against the budget. And then the third type of data there is the rolling forecast, which consists of the actuals to date plus the remaining budget, or an update of the budget if that's appropriate. Obviously, variance reporting is a must, because what we're talking about here is not a tool, not an application. We're talking a process, and that process is strategizing a business for the best results. So when we compare budget to actual, what went right or what went wrong? If it went wrong, what are we going to do to fix it? And that's where the value comes from. Obviously, you must have other reporting, such as KPIs, but in every case, it's got to be user configurable. A panel beater will require one form of reports, a restaurant owner will require another. And it's got to be able to look after both. So, I mentioned this case study, and it's an interesting one. It's a smallish restaurant. We have their results to the end of March. And before the restrictions came on, they were in fact marginal. They had been opening 3 services a day, breakfast, lunch and dinner. But about a year ago, they decided that they would close the dinner service and only open breakfast and lunch. And that had some slightly adverse results. They were a bit more marginal than they were previously. We have some statistics on their meals and takeaways. We know details of the food and labour costs, and we don't know that they qualify for the JobKeeper and cash flow assistance. But because they've been marginal, they ran up a debt with the ATO. They were unable to meet their ongoing commitments to the ATO, and they also had a bank overdraft. So not a good scenario, even before the downturn. And then they were told they got to shut. So what were they going to do? So here's the strategies that we started looking at, and I'll show you the model in just a moment. Firstly, they had 4 full-time staff, 2 owners, a full-time chef and a full-time front of house, and they had casual staff, which they put on as required, and they released those casual staff. They did that very quickly, as soon as they were told they would be shutting up shop. They applied for government assistance, and then they thought about what's going to happen later on when these restrictions ease. They needed to plan to get rid of that ATO debt and also run to a cash surplus, and obviously they needed to restore profitability. So let's have a look at the model, and we'll have a look where it was going. And what I've run up here, Peter, is just the actuals. Our Plan Guru, this is the tool that I use in support, as I said, and you can see here I've got the actuals from July last through to the end of March. It's a typical income statement, revenue, cost of sales, operating expenses, net profit. Just want to take you through a couple of quick things just to show you where it's all at. Here's their main sales line, so total revenue running at around 40 to 45,000 a month. Gross profit running between 25 and 30,000 a month. Operating expenses, and so you'll see here the income from ops down here, then we've got some interest, etc. And so income after other income expenses, a bit all over the place. And look, they'd only made $10,000 for the whole period through to the end of March, so pretty marginal. If we have a look at the balance sheet, Up in the top line is their cash and cash equivalents, where I'm measuring the cash flow result. That effectively is the bank account. And you can see they had an overdraft of $10,000 at the end of March, and it varied a bit over the period. You come down into the liabilities area, and you'll see their total ATO liability. You can see it started the year in July at 15. It peaked at around 29,000, in fact, at the end of March. So that's where it stood at the end of March when we started looking at this case study. And then if you have a look at the cash flow in Plan Guru is represented in one of two formats, both of which are internationally accepted. This is called the direct method, which starts from revenues, works through changes to come through to operating cash result, then looks at financing and investment activities, and then gives us a net increase or decrease in cash for the period. So you can see it was a bit plus and minus, and that's where we finished up with that 9,900 cash at the end of the period. So that's the cash flow. One of the great things about Plan Guru is that it is what you want it to be. So if I try and have a look here at here we go. I started budgeting from April, obviously. And if you have a look at the numbers over here, I'll just lead you through them. This is what's called the non-financial area of Plan Guru. And this is as big or as small as you want it. And it's like having your own Excel inside Plan Guru. Having said that, it's a little simpler than Excel, but it does allow you to do pretty normal calculations. So what I've done here is said that this restaurant is open for 30 days in the month. Right now in April, May and June, they're only doing takeaways, and we're saying that there's an average of 90 takeaways a day. The average sale value of the takeaway is $10. So for the month, 90 times 10 times 30, we've got $27,000 in revenue from takeaways. They're also located not that far from Brisbane markets, and they've got a good relationship with their fruit and veg wholesaler. So thinking outside the box, they put fruit and vegetable boxes outside the restaurant for sale to the public, and they've budgeted on selling 200 a month, and at an average of $8 a commission per box. So there's a little bit of extra revenue there. Their wage cost runs at 35%. And at the moment, we've got 4 employed. That's $1,500 a fortnight to qualify for the JobKeeper. So there's the $13,000. I'm actually looking at calculating casual wage cost. I'll come back on that. We also need to calculate PAYG for the cash flow assistance, and that runs at an average of 25%. Down here, I'm doing the cost of sales calculations, and cost of sales runs at 35% of sales. So you can see quite scientific in how I've approached this, but isn't this simple, because all of this is going to flow through into the income statement when I have a look at it. So there's my $27,000 a month in revenue coming through. If I look at my cost of sales, here is 2 cost of sales accounts, one GST, one non-GST, which we need to do for GST purposes, because Plan Guru even calculates GST. There's my GST calculation for the period, and that flows through to the balance sheet and obviously also to the ATO scenario. So just back to that income statement again. So sales, cost of sales, and my labour cost is all linked to that non-financial page. And you can see now that in April, May and June, we've got a small profit in April and May, small loss in June, and that's before the assistance. The assistance is government's going to pay the JobKeeper at $13,000 starting May, and it's also going to pay that PAYG cash flow assistance. So look at the huge difference that makes. Nothing to April, of course, but May we're now $21,000 profit, and June we're at $10,000. Well, for the whole of the year up to the end of March, we only made $10,000. And that, of course, translates straight into the balance sheet. And you'll see that we've now got some cash generated by those surpluses in June of 46,000, which again ties up with the cash flow report down here. There's my 46,000. So there we are. I'll just pause there quickly, Peter, in case you or anybody else has got any questions, because that's a very quick tour around how Plan Guru works, but it illustrates by by using drivers, particularly in our COVID-19 scenario, we've been able to take a business. It wasn't, I won't say it was ailing, but it certainly was marginal. And with the help from the government, thank goodness, they've been able to restore April, May and June. But now the last part of my presentation is to show you how we're going to do the next financial year when the restrictions ease.
Or what you could do in that case, of I know, is do some various what-if type calculations. If the daily volume of customers was going to go up 10%, or the average food consumption, it's very quick to put those figures in, isn't it?
Absolutely. I can show you here. If I came back here and said instead of the 90 in June, we actually did 120. Whoops, not 1,200, 120. I've changed that. My sales has already gone to 36,000.
Yeah.
But if I come back now to the income statement, there's your 36,000. It's flown right through to the bottom of the.
And cost of sales has been changed.
Cost of sales has been changed.
Yeah.
If there were any other percentages, they've been changed. The cash flow will have changed because that will have been impacted as well. Everything has been impacted in one short change, just like that.
Yeah, and that's the big benefit of this package.
Absolutely. And what you can do is you can say various versions of it. So what if it went to 120, but what if it went to 60? And then you can save a version for 120, you can save a version for 60, and later compare the two.
And this business could have had a business plan before all this to say this is what their strategy is going to be. And then you're telling the story, going through into the budget and then the cash flow, and you're proving it all with the predictive balance sheet.
Exactly right. If I have a look now at 2021 financial year, in other words, from July on, you can see that previously their restaurant sales averaged $16 per head. And again, they're open 30 days. So what I'm going to do now is just to say, well, okay, we've got the takeaways possibly going forward. And in this model, I didn't actually allow any restrictions easing in June, but equally I could have. But I'm going to show them from July, just for simplicity. So what I'm going to say is in July, while we were on the 10 limit, I think it's 20 now from memory, but let's say it was 10. Let's say we got 30 restaurant transactions. So we actually had 30 customers, maybe 2 times 10 for lunch and 1 times 10 for breakfast, but we get 30. And then let's say in August, we get that up to 60. And then from September on, we get to 80. And who knows what's happening after September? I don't think even Mr. Morrison knows what's happening after September. And I'll just make that go across to the right. So then I'll say, okay, well, what about the takeaways? Well, the takeaways are going to drop probably. So let's say we did 70 in July. We did 50 in August as the restaurant started to get going. And we did 30, we do 30 in September, and I'll take that to the right as well. So there you go. You can see my revenue now is 35,000 for July, nearly 44 for August, nearly 47, just over 47 from September on. Now, again, immediately, Peter, looking at your question, everything's now changed and updated. The P&L is updated, cost of sales is updated. But here's the interesting one. If I go back to that non-financial, we've got these 4 staff, but as the sales increase, so will our labour necessity increase. So what I'm getting Plan Guru to do is to say, what is our wage cost? Is it met by, at 35%, is it met by those 4 full-timers? In July it is. In August it's not. And the difference is 2,331. Plan Guru is calculating that. I haven't done that. Plan Guru is telling me that I will need 2,300 of casual labour in August, right. And I'll need 3,000 from then on. I don't know what happened with my formula there, but never mind. That's the whole way it does it. So that's already updated. And if I go and have a look at the cash flow now, look at the ending cash we're getting here. Now, that's after allowing to pay 20,000 for the ATO in July, nearly 40,000 in August, and 14.5 in September. I go back to the balance sheet. Here's the total ATO liability. Started at 51,000, down to 37, down to 5, actually showing negative, and then just building up again down here. So look, I've taken, I think, about 20 minutes just to show you. That whole model only took about 40 minutes to build, and I've got a whole story to tell,
Yeah.
as you correctly said. So Peter, I'll stop it there. I'm happy to handle any questions either now or later. But it was really interesting for me, as I said, personally, as I've worked a lot with food and beverage, and to see a real live COVID-19 case study.
And obviously in other businesses that have got debtors and have got big inventory investments, you can play with those figures. I suspect a lot of businesses are going to have problems with debtors from now on. Debtors days outstanding will probably blow out, especially if banks are going to be harder to deal with. People won't be paying their bills as quick. So this all needs to be taken into account in these projections, doesn't it?
Oh, indeed it does. So,
okay.
So thank you very much, Peter. And
thank you, Paul.
Thank you to your people for attending today. And if you've got any other questions or comments, here are my contact details, paul@beyondaccountingtechnologies.com. There's my landline, there's my mobile. I'm happy to talk to any of your subscribers.
Thank you very much, Paul. And just a reminder, if you are watching this on Facebook live or watching this at sometime it suits you, 2 a.m., 3 a.m. in the morning, some people tell me they watch this. Please don't ring Paul then and don't ring me. But anything after about 8 o'clock, he'll probably be okay to talk to you. And or send us an email and we will get back to you, because we are keen to help, because this whole series of webinars is really about COVID-19 and where what businesses are going to be able to do and what accountants are going to be able to do to assist your clients to navigate through this minefield. Okay, I now want to, we'll just switch back and I'm now going to talk to you about the COVID-19 update. And when I started writing this yesterday, I didn't think I had much to talk about, but then I read the financial review from yesterday, last night. So I've had to make some changes to my PowerPoints this morning. We'll come to that. A reminder that the coronavirus SME guarantee loans close on the 30th of September. The condition that the Reserve Bank made with the banks when this money totaled $105 billion was made available is that any money that hadn't been spent, hadn't been documented, had to be returned to the Reserve Bank by the 30th of September. I think it's going to be very difficult. And when you look at some of the comments I've got here for you, it's going to be very difficult dealing with banks. And therefore, people might want to take advantage of this loan, or a lot more people might be very interested in talking to Arthur Acker and the team at Equitize about looking at trying to raise capital as a crowdsource funding equity raising company or a Section 708 company. Financial commentators are predicting in difficulty in obtaining bank loans post 30th September. I'm sure accountants know that, but please be aware of it. And businesses definitely need budgets and cash flow forecasts prepared now. I've had some comments made to me from accountants, oh yeah, we're going to think about all this in October, November. And to follow on from Paul's example on spreadsheets, I don't think that's the right answer. It's the wrong answer. Your clients need assistance now in planning this. There's still an opportunity if they need up to $250,000 to negotiate a SME guarantee loan, the coronavirus loans, or they should be starting to think now about raising capital, because you don't do that in 5 minutes. There is a process, and then the period of time that the company can elect to take is 90 days to raise the capital, and most companies need that. And Arthur might comment on that in a moment, but the capital raising period for crowdsource funding, by the time you go through the preparation and then perhaps 90 days, is probably up around 150 days. These are the comments that have come out of yesterday's financial review. The heading on page 34, SME retailers seek rent relief from big malls. 80% of small and medium-sized retailers that are trading in the major malls around Australia, according to the Shopping Centre Council of Australia, have applied to the landlords for rental relief under the special legislation that's been introduced into Parliament. There's then a comment on page 32 of the financial review. Banks are worried about 200,000, and in fact the figure is 216,372 businesses that owe just under $60 billion. Now, these are clients of accountancy firms all over Australia that the banking industry is saying have got some real problems. These figures are supplied by the Australian Banking Association, which obviously is the bank's organisation. Perhaps you should be talking to those clients about their budgets and cash flow forecasts, utilising Plan Guru to do those calculations. And when you're looking at funding of the organisation, if they've got a viable business and they have a vision and a good leadership team, I'm sure Arthur would be happy to talk to them and talk to you with them about the opportunities that they may have in raising capital. There's more. Bankers have also commented on the very important matter that we're all forgetting, and that is we're in a embargo on action being taken against directors for insolvent trading or following up of monies owed to lenders at this stage. Those embargoes all end on the 30th of September, and banks are saying that medium-sized companies are starting to cause them concerns, and they're aware that directors are starting to focus on what they should be doing to make sure their companies are not trading whilst they're insolvent. And obviously that's very important all the time, but we've now had this bit of a false situation for the last 3 months, and we're still going to have it to the end of September, where no action's been taken against anyone. And one of the interesting comments is that insolvency practitioners at present, some of them are on the JobKeeper program, and a lot of them have dispensed with staff, but they expect to be flat out in October, November. What can you as an accountant do about that to help your clients? And then I found on a bit further on a survey from the it's in the same article actually on page 32 of the financial review of yesterday, a survey that's attributed to the ABS, Australian Bureau of Statistics, which surveyed 2,000 businesses, which they believe is an adequate sample. 26% experienced a drop in revenue of up to 25%. 37% had falls of between 25% and 50%. And this was in a week in June. I forgot to mention that. It's between the 10th and 17th of June. So these were really only 2 weeks ago. 17% suffered a fall of 50% to 75% in revenue. And 14% had plunged more than 75%. Very sobering figures to look at. Was for me at after 10 o'clock last night when I was reading all this and changing these PowerPoint slides. So we need to be aware of it as accountants. That same article indicated that 80% of businesses in education, training, accommodation, food services, media, communication, and arts and recreation had experienced a significant drop in earnings. If you've got clients in those industry categories, perhaps you should be talking to them and making them aware of the software that Plan Guru's got. And if you need some advice on predictive accounting, rather than my typo error, that they can get assistance. And if their companies are in the category that Arthur was talking about before, I'm sure he'll be interested in talking to you and them about being able to attempt to raise capital. And the same article indicated that banks are extremely concerned about what's happening in the tourist areas in Queensland, Southeast Queensland, and I could add the Whitsundays and Cairns to that list of major tourist areas that are suffering, and also now in Victoria because of this latest outbreak of COVID-19, and in the CBD areas of major cities. And there's some bank figures. The banks have lent an additional 18.9 billion to SME businesses and 4.5 million, I think that should be billion actually, to sole traders. Some good news for the arts and entertainment sector. The Prime Minister yesterday announced a $250 million mixture of grants and low interest loans payable over 12 months. So there's 75 million for grants of between 75,000 and 2 million for production and event businesses to put on new festivals, etc. There's 19 million in show starter loans to get shows produced. There's 50 million in grants, which will go to what is called a temporary interruption fund to help local film and television producers get started again. And there's 35 million in direct grants to arts and cultural organisations, and this is going to include theatre, dance, circus, music, and I know there'll be a lot of people very happy to see that. So what the Prime Minister has said is there's going to be support amongst those programs for tradies who design and make sets, and for computer specialists who create the latest special effect items that you see in live theatre and live productions. So it's very good news for those people. Ess Biztools can assist with business improvement tools to assist accountants, you people, to add value to clients. We have packages for crowdsourced funding, which we've been talking about today, early stage innovation companies, the COVID-19 package, which will help you guide your clients through this real problem. And unfortunately, I think we're only at half time when it comes to accountants' reaction to COVID-19. You've done a great amount of work up to now in getting clients into JobKeeper and other programs, but now some very heavy yards have to be run through that will help your clients survive. So we've got a debtors management package, research and development. A number of your clients may have used the time when they've been working at home to try to develop a new product, process or service. How do they get a taxation advantage out of that? Government grants and strategic plans, corporate governance. So you can visit our website to get details on that, essbiztools.com.au. Our next webinar is next Friday, the 3rd of July at 12 noon AEST. Our presenters are Mark Holton from Smith Inc., who's going to be talking on business advisory in the post-COVID-19 accounting industry. That's part 1 of Mark's presentation. And Dale Crosby, who is the editor of For Accountants website, is talking on Chief Financial Officer Services. So don't miss either viewing this webinar live or watching it as a recording or on Facebook Live. So to register, please go to www.essbiztools.com.au/webinars. For more information, you can go to our websites to learn more, or send us an email, peter@essbiztools.com.au, or you can telephone me if you wish, 1-800-232-088. So please stay safe. Thank you for your participation today. Thank you, Arthur, for your contribution.
Thank you very much,
Paul.
Peter.
Yes, thanks, Arthur, for your contribution. And please, everyone, remember, if you want to talk about crowdsource funding or any other capital raising, as Arthur summarised today, please give him a phone call in Sydney. Paul, thank you very much for your update and overview of utilising an excellent product like Claim Guru.
No problem, Peter.
So to you people watching this, as accountants and advisors, good luck in your firm. It's very important that you get your own house in order first. And don't forget to send us the questions if you have any. Have a great day. Thank you for being with us. Goodbye. And we hope that you all enjoy a bit of the football as it gets started again. And congratulations to Australian soccer on the Women's World Cup in conjunction with New Zealand being offered to Australia, which Australia and New Zealand will be running in 2023. Have a good day. Bye-bye. Thanks, everyone.